Today is May 1. And if you are here today, you're likely a working professional, juggling a busy life, a full-time employee. You may have big responsibilities around your family in the future. You might be doing well in your career. But when it comes to investing, you're either frustrated with the market, confused by the conflicting news that you hear, or you are just unaware and want to learn more. You probably heard everything from a recession is coming to market bottom is in. And you know what? Let's be honest, it's exhausting to keep up with all this news. I've been there. I totally get it. So here's what we're going to do over the next 30 to 40 minutes. First, we're going to look at what happened in Q1 and why the negative GDP number that may have come in recently sounds really bad, but what's really happening underneath it. We're going to look at what's happening right now, especially with the inflation, earnings, sentiment indicators that most people actually overlook. And finally, we're going to talk about the massive amount of cash that's sitting on the sidelines and why that could have a big impact on what happens next. This is not about short-term trades, right? This is about understanding the real story behind the headlines so that you can stay grounded, you avoid emotional mistakes, and feel proud of where you are and how you build your long-term wealth and financial security. And that is just going to be for yourself, your kids, and for your legacy. With that said, let's get going. So since the beginning of the year, here is how the different indices have worked out. So as of this morning, S&P 500 was at 4.87%. Dow Jones Industrial at 3.59%. This is down, by the way. So S&P 500 has been down by 4.87%. Dow Jones Industrial has been down by 3.59%. NASDAQ has been down by 6.7%. And Russell 2000 has been down by 12%. And for those of you who are in my Telegram group, I had also mentioned this morning that Meta and Microsoft released better than expected earnings. So they passed the surprise factor. And because they have such a large volume in these indexes, that it was expected that the market was going to open higher. And as it turns out, the market did open higher and there was a gap up in the market. And if you look at the S&P 500's performance right now, I think it's already gone up. And I'm going to later on also open up the live charts and show you what's happening. So this kind of goes to show that the market is overall down year to date, but there actually is a lot that has happened, which I'm going to uncover slowly. So there was a dip and then market went up. So let's uncover what's actually happening. I have something very fun that I'm going to go through in a chronological fashion. Now, before we dive into the data that I'm going to speak about, let me just share something personal. My own investment account, which is something that I manage on my own, which follows the same philosophies that I discuss, that I preach, that I teach, that portfolio has now fully recovered from the earlier dips and is sitting at 2% year-to-date return, while the S&P 500 is minus 5.31 and NASDAQ is minus 6.565. So this, I took a screenshot from my portfolio this morning. This is not always going to be, or the performance of S&P 500 is not going to be exactly as what I just mentioned in the previous slides, because these screenshots were not taken at the same time. But all in all, my portfolio is already up at 2.02%, which is right here. And that is higher than the S&P 500 and the NASDAQ. Now, I'm not saying this to impress anyone. The reason I'm saying this is because the performance is not about luck or market timing. It is about sticking to a process, the one that helps me focus on what actually matters and avoids reacting emotionally to scary news and headlines that's all over the media. Remember, bad news sells. They actually catch eyeballs. If the media starts to say, oh, everything is hunky-dory, but here's a real problem, but it's going to turn around, it's going to be okay, nobody's going to read that. People want to read the bad news because that's what attracts them to watch the news, read the news, and that's what keeps these news media companies afloat. Because if nobody watches them, what are they going to do? But us as wise investors, our job is to read under the news to see what's really happening. So as I've always been mentioning, my process consists of having high quality companies in my portfolio, having a contrarian mindset, having very clear diversification, and making sure that I purchase in tranches. I pre-allocate how much I'm going to invest in a certain stock based on a whole lot of analysis I go through. And then I say, I never put all my pre-planned allocation in one chart, right? I continue to dollar cost average. So over the last little while, as notice when the market was doing not so well, I continue to accumulate stocks. So when I continue to accumulate stocks, what happens is my purchase price goes down and my volume grows up. So when the volume goes up and the purchase price goes down, which is called the cost basis, then when the markets do recover, guess what? My growth happens to be much faster than that, and that's just pure mathematics. And you can even see that. Look at the slope of growth here in the S&P 500 and the other index, and look at the slope of growth here. It's a sudden jump, right? Anyhow, carrying on, I'm sure we'll be discussing a lot of this in the near future. Now, folks, this is that exciting slide that I have where what I've done is I've written out a chronology of what's been happening in the market in terms of tariffs. Because don't forget, the stock market has gone down not because there is a structural flaw in the companies whose stocks are represented through the indexes or the stock market. This correction that has happened is a direct result of what President Donald Trump has been doing from the point of view of tariffs. So I have written down a chronology and I'm going to show you how the market reacted ever since President Donald Trump got inaugurated. So President Donald Trump got inaugurated on the 20th of January. So on 20th of January, when he got inaugurated, the market continued as it was continuing. So it was somewhere around here. The market continued to go up. Then on February 1st, he announced that he was going to apply 25% tariffs on Mexico and Canada and 10% on China. So that was around here. And notice market didn't necessarily negatively behave. It actually continued to go up. On 3rd of February, which is somewhere around here, he said, I'm going to put a 30-day suspension on Canada and Mexico. Again, market did not have any reaction. Market continued. Then on 20th of February, Trump said that he wants to impose new tariffs on all sectors, including pharmaceuticals, semiconductors, and automobiles. So that was 20th of February. Look what happened. On that day, market did not like that news. It ignored Canada and Mexico. It ignored China in the beginning. But when Donald Trump said, I'm going to impose this everywhere, market didn't react very nicely and it started to go down. On March 4th, he said that the tariffs on Canada and Mexico will be implemented. So let's look at March 4th. So this is March 6th. So somewhere around here, he said that, not he said, but the tariffs that he had would be implemented on Mexico and China. What happened on that day? The market kind of actually stayed stable. One could even argue maybe the market went up. On April 2nd, which is somewhere around here, the evening of this day, actually, it was the evening. So on the evening of April 2nd, he called it the Liberation Day, and he said, I'm putting tariffs on 57 countries and a universal tax on every country of 10%, right? The next day, market had a gap down. It opened well below, and it continued to go down. On April 5th, he implemented that 10% tariff. So that was somewhere around here. He implemented the 10% tariff, and the market continued to go down. So it didn't do really well either. But on April 9th, one day after that, Donald Trump said, okay, I'm putting a 90-day pause on most countries. But he announced that I'm going to put 145% tariff on China. Guess what happened? The market jumped. It jumped so much that this was the biggest jump that the market had seen since 2008. It was the biggest single day jump, and the growth this day was 9.5%. Even I had to look at my portfolio a few times and like, is that growth real? But that happened. But that goes to show that, you know what, you want to stay in the market. You don't want to get out. So, because if you get out, these kinds of big days come, and if you miss out on those, and that can, over time start to significantly impact your portfolio. Now, on the 17th of April, which is somewhere here, Donald Trump said that I want to fire Powell, which is Jerome Powell, who is chair of the Federal Reserve. So when he said that, look what happened. The market went down. Market did not like that. And then suddenly on the 22nd of April, somewhere around here, he said, okay. I'm not going to fire him. I have no intention of doing that. And look what happened. The market jumped. So this basically goes to show how the markets are severely impacted, at least in this time, by essentially what's happening in the news and not necessarily fundamentally what's going on in the companies, in their financial situation, etc. So that's why I say the market in the short term is very emotional, but in the long run, it catches up to the intrinsic values of the companies. So you also might remember that in early April, there was a wave of headlines claiming that China was dumping US treasuries. So remember this happened in early April. And because China was dumping the US treasuries, what that was doing was is when the volume goes up, the price goes down. And when the price goes down, the yield goes up. So they were saying that the growth in yield is a result of China dumping their bonds. And China is doing that strategically because when the 10-year treasury yield goes up, that also increases the interest rates. Now, as more data came out, it turned out that this narrative that was going on is very wrong. This was misleading. What was the real story? The real story is that China was actually not offloading treasuries. It was actually large hedge funds that were selling their treasury yields to meet margin calls, especially in response to the volatility driven by new tariffs. And these hedge funds were doing that because they were highly leveraged and they were using a strategy called bias trades. And when the markets got rocky, they had to unwind those positions very, very quickly. So what they did was they started to sell their bonds so they're not affected by the banks who were going to start calling margin calls on them. And this selling pressure is what caused spikes in yields and not geopolitical dump by China. And this is a perfect example of why we always want to go beyond the headlines and understand the mechanics behind the market moves. So this here's the Q1 result that came out, and it was minus 1.3% or minus 0.3%. So that showed that the GDP has come down. Now, obviously, that's going to cause a lot of fear. The biggest driver of that decline wasn't collapsing demand. So if the GDP going down was because the demand was going down or there was a slowdown on consumer spending, then that would be concerning. But what actually ended up happening is that this decline was a direct result of the heightened imports that happened. So when Donald Trump was about to put tariffs, a lot of American importers wanted to avoid those high tariffs, so they increased their imports. So it was that significant import that increased that actually is now showing to have caused a decline in the GDP. Unless you're looking at Atlanta Fed, which regularly monitors the performance of the GDP in real time, when you look at all the related other figures, the GDP performance is actually of the previous quarter. And by the time we find out that a recession has happened, which means a decline in the GDP for 2 consistent quarters, guess what? By that time, typically the economy is already on its way to recovery because those figures are historical. This is why I have titled this slide a backward look. So while the imports were low, the investments in the economy had increased. Consumer spending has also increased. When this happens, this means consumer confidence comes back in, and because investments are happening, that also shows a positive sign. On the inflation side, we did see a spike. The Fed's preferred inflation gauge is the PCE. So the PCE actually went up. And let me show you where that is. There you go. So here's the PCE index. So as I mentioned, on the inflation side, we saw a spike. The Fed's preferred inflation gauge, which is the PCE price index, rose to 3.6%, which was up from 2.4% the previous month. And the core PCE, which strips out food and energy, also jumped to 3.5% from 2.6%. This tells us that inflation pressures were building during the quarter. But just remember, the GDP dip wasn't because of the demand collapsing. It was actually an accounting effect from tariff-driven import surges. Now, as I mentioned, that the previous slide talked about the backward look, which is what the official GDP figures are going to show. I'd like to shift our focus to the present moment, which is the second quarter of the year, and look at where the inflation actually stands as of right now. So if you go by the Federal Reserve's preferred inflation gauge, which is the personal consumption expenditure PCE index, we actually seeing some signs of cooling instead of growth. So in March, the core PCE, which excludes food and energy, came in at 2.6%. So it was sitting at 2.6% here. uh, which is a year over year growth. And this was down from 3.5% in the prior quarter. So prior quarter was sitting somewhere here. And while this is still the Fed's 2% target, it's still moving in the right direction. So remember, Feds are trying to bring the inflation down to 2%. Now, this kind of moderation suggests that the price pressures are stabilizing, likely because consumers are spending more cautiously and businesses are becoming more selective in how they increase the prices of their products. Now, one important caveat is that March data does not yet include the impact of new tariffs, which is what I just showed you earlier, right? So it doesn't include the impacts of new tariffs that were rolled out in April. Those could actually raise the cost again in the month ahead, especially if the companies pass those higher imports onto the consumers. So yes, inflation remains above the target, but the good news is it's not spiraling. And the trend is moderating, and that's also a positive sign. And let's not forget the consumer spending is still intact. The wage growth hasn't fallen off the cliff. And that tells us that we're not in a demand driven recessionary period yet. And that's a very important thing to remember. Now, let's shift our focus from macro headlines to what's really drives the long-term market performance, and that is earnings. Because let's be honest, price without earnings is just speculation. And as of 25th of April, more than half of the S&P 500 companies or companies in the S&P 500 have reported their Q1 results. And here's a kicker. Over 77% of them beat the earning expectations. And that's a very strong result, especially in the kind of uncertain environment that we're in. So of course, not all sectors are performing equally as well as we would expect. We're seeing some softness in energy and consumer staples, but at the same time, tech and industrials have been holding up really well. And that speaks to the resilience of these companies and the diversity across the markets. So if you've been hearing headlines about the economy is falling apart, well, folks, this data gives me a more balanced story. The economy may be facing headwinds, but the corporate America is still generating profits, and that's a signal worth paying attention to. So have a look at this. So here, this is the S&P 500, and so the green part of these bars shows returns of companies that have beaten expectations, and then it also shows which sectors they belong to. So healthcare sector above average is 89%. Information technology is the next one, 81%. Consumer service, communication services, then financials and industrials. The ones that haven't done really, really well this time are around R, consumer discretionary, utilities, and energy. And the second table chart here shows growth. So healthcare has seen a year-over-year growth of over 35%. Communication services has seen a growth year over year of 23%, information technology 15%, and so on and so forth. And these companies, these sectors that are not doing well, they are also reflected in their year-over-year performance, which are sitting in the negatives or very close to zero. As I was saying in the previous slide, that the performance of the stock market is in the short term very emotional, but in the long run, the prices of stocks actually come up to their intrinsic values. And the intrinsic value or the fair market value of a stock is driven by the company's earnings. So let's see how the earnings have been doing. So here is my slide that shows all the different companies that are publishing earnings this specific week. So you'll notice that on Monday, a whole bunch of companies came out with their earnings, Tuesday, Wednesday, Thursday. So Domino's Pizza came out, and then Coca-Cola came out with their earnings, and then Booking.com, Microsoft, Meta. And notice on the right side, I have shown what was the expected earnings per share and what was the actual earnings per share. And this is obviously for this quarter. So however the company performed this quarter, their earnings were released. So EPS for Visa was supposed to be at 2.68%. It turned out to be 2.75%. So there was a surprise factor of 0.7. Similarly for Microsoft, it was expected to have an EPS of 3.23. It gave an EPS of 3.46. Again, a surprise factor. Meta, 5.28 was expected. It gave 6.43, a significant surprise factor of 1.15. Obviously, these heavily impacted the confidence of consumers. So their stocks opened up very high this morning. Qualcomm did not do, slightly did below the expectations, but Apple it has also beaten expectations. And this week we're supposed to get earnings by Amazon, McDonald's, Berkshire Hathaway, and ExxonMobil. These are big companies that have large shares. So based on how they behave or how their results come out, we'll see how the stock market behaves. Now, going back to something Vijay asked, I have a whole bunch of indicators and what's happening in the market to show that, are the realities contrary to what's being shown in the news? Let's analyze that. So I'm going to bring your attention to something that doesn't get much attention in the mainstream media, but historically has been one of the most reliable technical signals out there, and it's called the Zweig Breadth Thrust. And this signal measures the percentage of advancing stocks in New York Stock Exchange over the short period. And when this number surges quickly from deeply oversold to broadly positive, it signals a sudden shift in momentum. In short, it tells us the market is starting to gain internal strength. And here's the interesting part. This signal just got triggered again in April, not too long ago, just a few days ago. And historically, when that happens, it has often led to strong numbers in the following months. Not because of hype, but because more stocks are participating in the recovery. Now, does that mean that we go all in today? No, absolutely not. But it does suggest that what we are seeing isn't just a rally in a few big tech companies. There is potentially a broader participation happening under the surface. In other words, this could be early stages of a technical bottom forming. And that's something worth noticing, especially for long-term investors who have been waiting for signs of strength. So let's take a closer look at why this signal is so important and why it caught my attention this month. So this signal is not just any other indicator. It's actually a very rare indicator, and it has a remarkable history of its track record. Since World War II, this signal has been triggered only 19 times. That's it. Okay, but here's what's even more impressive. According to a strategist named Ryan Dietrich and several other sources that I found on Investopedia and NASDAQ, every single time the signal has been triggered, S&P 500 has delivered positive returns over the next 6 to 12 months. Its performance has been 100% over 12 months. And let me give you some actual numbers. So notice that, so here's all the times when in the history this signal has gotten triggered. And then it shows you what were the average results, or what were the results of the S&P 500 in 1 month thereafter, 3 months thereafter, 6 months thereafter, and 12 months thereafter. You'll notice then it gives you an average, a median, and a percentage higher. So on average, whenever this signal has been triggered since the World War II, over 1 month, the average growth of the S&P 500 has been 4.8%. The average growth over 3 months has been 7.8%. Over 6 months has been 15.3%, and over 12 months has been 24%. That's phenomenal. But I want to caution you folks. Past performance is never a guarantee of future results. So don't come back to me and saying, Amit, you said it was supposed to be 100% positive. It's a signal. We have to watch it and look at it from an entertainment point of view. But now I'm going to dive deeper into seeing, are any other things happening in the market that kind of go to support or refute maybe what's happening in the growth that we're seeing? Well, let's see. Okay. So here's something that most people didn't expect during a downturn, or do not expect during a downturn. During a downturn, individual investors hold on to cash, right? But individual investors, which are retail investors, this time have been net buyers of stocks, even when the headlines were screaming that there is a recession coming. Now, that's a big deal because in the past pullbacks, we often saw panic selling from individuals, but this time the behavior has been different. So here's a chart that shows me major indexes remain down from their peak in February, but individual investors are putting more and more money in the US stock market. So how much money got put in? $1.57 billion got put in. This connects directly to what we just discussed, which was the Zweig Breadth Thrust. So I may be saying the name incorrectly. I don't know how to pronounce it properly. But remember, this signal is triggered when the broad set of stocks start advancing quickly, not just a single sector like the big tech companies. And the fact that all retail investors have been participating across different sectors, not just chasing the Magnificent Seven, contributes to the breadth that I just talked about through that ZBT indicator in April. So what we're seeing is not just a technical momentum. There's a behavioral shift happening underneath. And when everyday investors stop running and they start allocating rationally, that can support a stronger, more sustainable market base. Is there anything else that goes to support anything like that? Well, let's have a look. Here's another important clue about what the investors have been doing and what their behavior has been when it comes to investments. So there's something called a money market fund, right? And money market fund data also exists very openly in the market. So I got it from Y Charts just this morning. And what I noticed was that there is, as of now, $6.9 trillion worth of money sitting in money markets. So why do people put money in the money markets? When they, want to keep the money safe. So 6.9 trillion has been sitting on the sidelines. But here's an obvious question. You notice this decline? Why did this decline happen? One of the reasons why this decline may have happened is because people have pulled money from money market and they may have put it in the stock market or equity markets. And I think there is a big likelihood that a portion of this money got moved into the stock market. Now, think about what we've just covered. We've just covered that individual investors in the previous slide stepping in instead of pulling back. And market breadth is increasing through that indicator that I showed. And now that we're seeing that the cash is moving away from money market accounts potentially to the stock market, then one, we could say that, hey, Amit, is it moving into gold? Well, maybe let's look at that. Let's look at gold, and also we'll look at the treasury bonds. So here I have the S&P 500 in candlesticks. And what I see on the top is gold. And then what I see underneath is the 10-year treasury yield. So notice that treasury yield is going up. When does the treasury yield go up? When the treasury prices go down. And when do the treasury prices go down? When people sell treasuries, right? So then the supply increases or demand goes down, and then the treasury yields go up. Now, so it's possible that as the treasuries are being sold, that money may also be moving into the stock market. And gold. Notice the gold was increasing. Why was it increasing, or why does the price of anything increase? When the demand increases. When the demand increases, that means more people are purchasing. But then notice the price started to go down. When does it go down? It goes down when the demand starts to go down. When does demand go down? When people start selling those assets. So when the gold prices have been recently going down, that means people are selling, or retail investors are selling gold in which they were earlier having faith. Where do you think that money is going into? That's potentially also going into the stock market. And when do people start putting money in the stock market? When they think in the long run that the fundamentals of the economy are looking good, or the fundamentals of the stock market are looking good. This reallocation of funds contributes to a broad market participation that we've been discussing so far, which is a key indicator or a component of that Zweig Breadth Thrust signal that got triggered in early April. In essence, a rotation from defensive assets like gold and bonds into equities supports the idea that investors are regaining confidence in the market, further reinforcing that the momentum indicated by that signal that I showed may not be an anomaly. Now, do we know if ultimately the market is going to go up? No, nobody really knows. But as long-term investors, it's wise to stick to your philosophies, because all the macroeconomic news, folks, is just entertainment, right? Investments are not based on what's happening in the macroeconomics. Because remember, if you have taken my training, the free course training that I have, and it's also a chart that I've spoken about widely in the past, economy is not the stock market. Most people invest in the stock market thinking like it's economy. But remember, stock market is a leading indicator of the economy. And by how much? 6 to 12 months. So whatever happens to the stock market today, 6 to 12 months later, it's going to show up in the economy. So as investors, what do? It's wise for investors to take advantage of market dips, but keep the process in mind that I speak about, which is diversification. Make sure you're allocating in tranches, make sure you pre-plan your allocations, et cetera, all the wonderful things that I've spoken about. Folks, that brings me to the end of today's market analysis, and I'll open it up to questions if any of you have any. Thank you.
Yeah, Amit,